Good evening. I'm Dr. Fred Rouse, the Real Money Doctor. It's currently just a few minutes before 7 o'clock on Wednesday. Where are we at here today? June 10th. And I want to touch base on the daily events that affect the way you get, protect, and enjoy your money, your life, and your retirement. The question for today is, really? More stimulus checks? I'll get to that in just a few minutes. For now, I want to touch base on the current number of COVID cases, which is currently 1,996,000 cases. That's up about 23,000 cases since yesterday. The deaths in the U.S. right now are at 112,726. 112,726 people have died basically in the last 5 months. Okay, that is a major, staggering number. A major number. A lot of people have been affected. And as I reported yesterday, those numbers are probably underreported. So the number is probably higher than that. Either way, it's another 975 people that have died since yesterday. New York State has the highest number of people that have contracted the disease right now, 380,000 people. That's up 675 cases or so since yesterday. Their deaths right now in New York State are 30,500. That's up another 42 since yesterday. So that's a good number for them. But again, 42 people have died. Okay. If you're one of the 42 or as a member of your family or a coworker, you're not happy. Okay. New Jersey still has the second number of highest cases. Okay. 165,000 cases, another 550 since yesterday. And their deaths right now are 12,377 people have died basically in the last 5 weeks. Again, that's 74 since yesterday. Their numbers are coming down. And again, we discussed this yesterday, and that the numbers on the coast in the major cities that got hit hardest first are coming down. It's the smaller cities, the smaller communities, the smaller counties that are starting to get hit. Right now, the number 3 spot is Illinois, number 4 is California. Massachusetts is number 5. Pennsylvania still remains at number 6. Texas is number 7. Michigan, Florida, and Maryland round out the top 10. Now, in all these states, okay, at least on the coasts, both coasts, the numbers are coming down. But again, a lot of people have died in the last 5 months. A major number of people have died in the last 5 months. And they're still dying, okay? This is happening as all the states have reopened in some way, shape, or form. Every state has reopened. Some actually never really closed. There's still no treatment. There's still no vaccine ready for widespread use this year. The chances of that happening are almost zero. They really are that slim, okay? Now, there's news on the money front today, okay, which is a little bit different. The Federal Reserve today said it was going to hold its benchmark interest rate near zero through 2022 to help the economy recover from the coronavirus crisis. Now, the Fed has cut interest rates as low as they are going to be right now without going negative. Okay, so they've dropped them all the way basically to zero. Other than that, they'd have to go negative, which means they'd almost pay you to take money from them. Now, the economic shock from COVID-19 may call for really drastic measures, but negative interest rates are not one of them, okay? At least not yet, and that's according to people at Bank Rate there and working with the Fed. In addition to slashing interest rates to near zero, the central bank also said it will continue to increase bond holdings to preserve the flow of credit. Along with the rate decision, the central bankers projected Wednesday that the economy will shrink 6.5% in 2020. 6.5% shrinking of the economy. However, the Fed says that 2021 is still expected to show a 5% gain, okay, followed by 3.5% in 2022. We'll see what happens. We'll see what happens. With millions of people out of work, and a growing number of Americans still feeling, severely cash strapped, historical low borrowing rates generally mean loans are cheaper if you can get them. Although the Fed's fund rate, which is what banks charge each other overnight for short-term borrowing, is not the rate that consumers pay, obviously. The Fed's move still affects borrowing and saving rates that you see every day. Now, for example, credit card rates are down to a 4-year low of 16.01%. Isn't that thrilling? They're only going to charge you 16.1%. And that's at a 4-year low. From the high of 17.85% when the Fed started cutting their rates in last July, and that was according to bank rate. So these are verified numbers pretty much. Now, the U.S. is in a recession, but the stock market keeps going higher. Okay, credit card interest rates, are already at the lowest level we've seen in years. But they're still high, said Matt Schultz, chief industry analyst for Compare Cards. Further, as conditions worsen, credit card issuers have begun closing accounts and lowering credit limits, particularly on those accounts that are at greater risk of becoming delinquent. So banks are being tight with all the lending right now as they get their feet under them in the wake of the recession, according to Schultz. And what's happening is, at the same time, mortgage rates are substantially lower, and that benefit is only going to increase, but only if you can actually get a loan. The average 30-year fixed rate loan right now is at a record 3.47%, according to bank rate. However, some lenders have actually stopped offering certain refinancing options and the jumbo mortgage programs due to the no risk in the market from mortgage bailout programs and the CARES Act. Now, credit is tightening. So while rates are at record lows, fewer borrowers are actually able to take advantage of that. Now, are people just stashing cash off to the side? It's really hard to tell, but probably yes. As savings rates continue to shrink. Although the Fed really has no direct influence on the deposit rates, those tend to be correlated to the changes in the federal funds rate. It's like the gas prices. They never, they might drop $1 for a barrel, but you don't see any change in the pump for quite a while. Same thing with the credit markets. Their rates are down to near zero. But you as a consumer, are you seeing much of that? Probably not. And even though the rates are lower, the chances of getting loans have decreased considerably. For, again, all of my clients, the people listening to this program, your chances of getting money have dropped out considerably. Now, if you're in the top 2%, you can care less. You're sitting on tons of money already. You can cry poor all you want, but you got multiple homes, multiple accounts, offshore accounts. You got money coming out the wazoo here. My guys, that watch this program, the small guys, select individuals, small guys with 0 to 6 employees, small businesses, working out of their homes. These guys are not getting money, and you know it. It's hard to get money right now. Now, according to the Federal Deposit Insurance Corporation, the average savings account rate right now is a mere 0.06%. And it's even less at some of the higher retail banks. Online banks such as Marcus by Goldman Sachs and CITI offer slightly higher returns, but it's just due to their lower overhead. Because they don't have the brick and mortar places. However, those rates are falling as well. Online savings account rates have fallen to near 1% after less than 3 months of the Fed's new zero rate policy. So you're not getting any money on your money. The big bankers keep making money. They borrow back and forth at no interest at all for them. If you were able to actually get a loan, they're going to charge you deeply for that. If you put money on deposit with them, they're not going to give you anything. What a surprise if things really changed all that much, which really brings me to the question of today. Really? More stimulus checks? uh, I saw this a couple hours ago, and we try and keep you up to date as much as possible. Treasury Secretary Steve Mnuchin today said he would seriously consider more direct payments to individuals in the next phase of the coronavirus rescue legislation, adding that funds should be targeted to help sectors struggling to reopen, including hospitality and tourism. Well, isn't that nice of them? Okay. Something they probably should have done right at the beginning, because those are the ones that are hardest hit, and they're still having a hard time to reopen. Okay. Restaurants and tourism, okay, we're just barely making it before. Okay. Restaurants at 80% capacity, we're just covering the bills. Now, with the reopening, you can see what they're doing. They want them to have basically 25 to 30% of maximum capacity. That's going to be their capacity for a while. It's going to be really, really difficult for restaurants to stay afloat like that. They still have the same overhead. The rent hasn't dropped out. The food cost hasn't dropped out. The labor cost has not dropped out all that much. But the dollars coming in the front door have dropped because they're certainly not allowed to put that many people in the seats anymore. No. Mnuchin was testifying today before Senate Small Business Committee, and he said that the Treasury planned to issue new guidance this week to ease the rules that prohibit business owners with a criminal conviction in the past 5 years from accessing the forgivable PPP program. Okay, loans that would be reduced in 3 years, and further little programs that would help those guys. But you're talking a really, really, really small percentage that's going to really affect at this point in time. Now, Mnuchin said definitely believed another round of federal coronavirus aid would be needed, including measures to actually create jobs. Now, Congress so far has passed 3 bills totaling over $3 trillion in programs, including small business payroll loans, payments to individuals, money for healthcare providers, and the Federal Reserve credit market backstops. Well, we will have a significant amount of unemployment, and we're going to need to look at doing something there. That's what Mnuchin said. I think we're going to look seriously at whether we want to do more direct money to stimulate the economy, but I think it's going to be about getting people back to work. Okay. The Treasury chief, and he's been doing this since this recovery got started in some way, shape, or form. He's the one who negotiates the programs directly with congressional leaders. And he said he was open to repurposing some of the unused money. I noticed it yesterday. I didn't report on it. Maybe I'll touch base on it tomorrow. But a lot of the PPP money got returned. So they're still sitting on a big hunk of this stuff. What happened was people took it, and then they found out that the rules weren't anywhere near as clear as they thought they were going to be, that they might have to actually pay it back or pay it back with interest. It wasn't going to get forgiven. So they just decided they didn't want to take it at all. So they're sitting on a big chunk of this money. And he said, would he considering allow some of the $130 billion that was unclaimed in PPP funds to be used to rebuild businesses damaged during recent protests over police brutality. Now, Mnuchin said he'd consider the idea, but he cautioned rushing into a fourth bill as the economy was just starting to reopen. But some sectors that have been really slow to reopen, including restaurants and travel-related industries, may need more help. He went on to say small businesses, by the way, and many big businesses in certain industries are absolutely going to need more help. Now, that's nice. But again, the help has always been slow to come. They talk a good game, but the money's not getting to the street. The stock market keeps going up. Again, it's all about Tina. The people with 2% money, 2% of the wealth in the country, all the tax breaks, they have no other alternative. They got nowhere else to put the money, so they throw it in the stock market. The stock market goes up. The businesses on Main Street are struggling. Okay. Restaurants are taking a major hit. Okay. Now, as more and more states continue to open parts of their economies, okay, we're getting a glimpse of what life's going to look like in the new, post-COVID environment. Now, we're already seeing some of those changes. The term social distancing we didn't know about 6 months ago is now pretty much commonplace. The idea of wearing masks was, what you did when you went to rob a 7-Eleven. Okay, now you're very much required to wear a mask if you're out in public. Okay, those are new norms, and they're likely to be that way for an extended period of time. There's probably going to be a fourth stimulus bill. Okay, Mnuchin's hinting at it. Okay, the Democrats are pushing for it. It's going to be try to micro-target pretty much the states and municipalities that have taken a major, major hit. Okay, because again, their sales tax money is not coming in. Payroll taxes are not coming in. They're getting a big hit. Okay, and they're going to try and get more of it to small businesses, but again, for the government to be able to do that, it's going to be interesting. It never seems to work out all that well outside of direct checks, which aggravates everybody. Nobody really likes a direct check. They don't mind taking the money, but if you're a business owner, you want to be in business. That's why you formed your business. You want to do business, and you're having a hard time doing that. The Fed still tries to figure out what they're going to do with the rest of the year, and they're uncertain. Again, we're in a recession. They acknowledged it even. And like I said, when at the beginning of the show, when I started doing these back in March 20th, I think is when I got started. Okay, we're all going to get through this. Okay, most of us anyway. Okay, and life is still going to go on. And life is going on. It's changed considerably, however, from what we knew before. And there are really ever increasing signs that life is, is starting to go on. Things are starting to pick up. You're seeing more people out and about. Most people are wearing masks. They're trying to social distance as best they can. Okay. The economy is definitely picking up, at least where I'm sitting at. Okay. In the Pennsylvania area. I can't see everywhere. And again, we discussed that also, in that your views are tempered by what you see. What you see is the reality that you're living in, but may not necessarily be the reality for someone else. Now, as the cases come down on the East Coast and the West Coast, you've seen already what's happening in some of the smaller communities. Again, with the meatpacking plants specifically. Okay, they're having major outbreaks. Now, Fauci was on today some point in time, and he acknowledged that, hey, 20 states are having an increase in cases right now. And he's not happy about that. And the people in the states are not happy about it either. But for the most part, things are continuing to happen. Okay. And with all the problems, if you were having problems back in December, you were looking to retire sometime last year, you're 50 plus, 55 plus, and God, things are okay. The market's going up right now. This is back in, last year, some point in time. And you're hoping to retire in the next 2 to 3, 4 or 5 years or so. That'd be great. And then December comes and you didn't have enough money at the time. You sort of thought you might be okay, but you also thought that you didn't really feel 100% comfortable that you'd have enough money to retire, but it was going okay. And you can work a couple more years and you save a little bit more money and you'll be okay. But then came January and then February and then March, when everybody actually acknowledged that the problem from January existed. COVID happened. We've been shut down for a while. So if you had problems back in December, you weren't certain you had enough money then. You're pretty certain you don't have enough money now. And that hasn't changed. The problem with COVID and the shutdown just really laser focused the light on the problem that you had before. And you had it before, but you were tended to ignore it because it wasn't front and center. It's something you could sort of live with, you thought, for a while. Well, now, here we are 5 months into this thing. You're just 5 months older than what you had before. The problem hasn't gone away. You had a short window of time to do anything with it then, back in December, October, November, December. Okay. You had a short window of time to do anything then that was going to have a meaningful difference. I mean, the financial planners for years have been telling you, oh yeah, save $700 or $1,000 a month and you'll be fine after, 30, 40 years. You might have $1.2 to $1.5 million. That's great. But things happened along the way and you couldn't do that. Okay. You got married. Maybe you got divorced. You lost more than half your money in divorce. Maybe you got married and you had kids. Okay. Savings for retirement got tossed out the window then. You bought a house. The house needed repairs. The roof went. The hot water heater went. The car went. You changed jobs. If you're 50 plus right now, chances are you've changed jobs over a dozen times already before you hit age 50. So you couldn't save the way you wanted to save, and things happen. And now you're 50 plus and you're looking to retire at some point in time. You don't really want to be working to your 80s and beyond. Okay. It's if your health holds up that well. And you see what happens with people when they hit 60s. Okay. Their health starts to fade. Things start to happen. The body that you've been neglecting for the last 10, 15 years is starting to catch up with you now. So what do you do at this point in time? Okay. The financial planners are very willing to sell you more of those mutual funds. They know that they're not going to do anything for you except generate a commission for themselves. And if you put money in mutual funds, that's great. Maybe you have $100,000. That's probably $60,000 more than most people have. But if you're 55 plus, that's not going to keep you for anything at all. You know that. So what do you do? Okay. Is it time now to be honest with yourself? Not to push this off in the back anymore? All these people tell you it's too late for you. Okay. They're willing to take your money, sell you more mutual funds and annuities, but they know it's too late. I had dinner with a guy from Wells Fargo, been at Wells Fargo for years. He's a financial guy. Been working in financial services for 40 years. And obviously didn't have dinner with him anytime soon because we've been shut down for, the last 3 months like everybody else. But we did have dinner at one point in time. And I asked him, well, what happens if somebody walks into your office, they're 55, and they have $300,000 and they want to retire? And he's eating without picking up his head, without dropping the food off his fork. He says, they're screwed. They're screwed. This is from somebody who knows what's going on, who's been seeing clients for 40 years now. 55 with $350,000 in savings, and he says they're screwed. And that's the general sentiment, that it's too late for you. But it's really not. Okay? If you're listening to me tonight, it's not too late for you. You can get the retirement that you want, the lifestyle that you want and deserve. It's not too late. Now, I'm a certified financial planner, okay? A multiple best-selling author. I've written books with Jack Canfield, written a book with Brian Tracy. He's the guy who taught Jack Canfield and who taught Tony Robbins. Okay? I've written books with these people. Okay? I've worked with clients for 40 years, select individuals, small businesses with 0 to 6 employees. I've shown them how I turned a $5,000 account into $57,000 in just 1 year without leaving the house. And I can show you too. Now, I can't work with everybody. I'm retired. Okay. I want to help. This is what I do in retirement. I have a good time doing this. I get on a phone calls with people and I see where they're at, if I can help them or not. Okay. Can I actually get you the cash flow you need so you can retire next 3 to 5 years? There's a fair chance of that I can do that. So go on my website, drrousenow.com. Okay. There's a 12-minute video there, explains the program that I've developed. It took me over 10 years and $350,000 to develop this program. Go there, watch the video, see if you're interested in the program. If you are, schedule a call. Okay. I can't guarantee you that I can do anything for you. But It doesn't cost anything to schedule a call. You can't buy anything on the call. It's not what I do. I'm not interested in trying to twist anybody's arm to do anything. I just want to see, where you're at. Do you really have a need or not? If you do, can I actually help you or not? And then third, do I think that we could actually work together? Now, I'm Dr. Fred Rouse. I'm the Real Money Doctor. My only goal is to help you get, protect, and enjoy your money, your life, and your retirement. Now, I appreciate spending some time with you tonight. I look forward to seeing you again tomorrow around 7 o'clock. Thank you.